San Miguel Corporation's parent company entered 2026 with familiar strengths and evolving risks. At its core, the parent acts as the financial command center, directing capital across power, food, infrastructure, and property. The numbers reveal both resilience and growing complexity. Total assets stood at 1.275 trillion pesos at year-end 2025, a slight uptick from the previous year. Yet beneath this stability, the capital structure became more leveraged. Liabilities expanded to 789.1 billion pesos, while equity declined to 486.3 billion pesos. The parent continues to invest aggressively, committing 855.1 billion pesos to major subsidiaries, including San Miguel Global Power, food and beverage, infrastructure, and equity investments. This investment-heavy strategy comes at a cost. Interest expense and financing charges totaled 40.8 billion pesos, notably higher than the 37.0 billion pesos received in dividends and distributions. The gap underscores a persistent challenge: financing costs that outpace cash returns from subsidiaries. While the parent narrowed its net loss to 5.3 billion pesos in 2025, down from a 14.8 billion pesos loss in 2024, easing forex pressure and improved dividend flows could not offset the financing burden. Debt maturity is a focal point for 2026. Current maturities surged to 85.1 billion pesos, up sharply from 8.1 billion pesos the year prior, while long-term debt increased to 694.9 billion pesos. Loans payable stood at 66.6 billion pesos. For an enterprise of San Miguel's scale, the debt wall is not an immediate distress signal. The parent generated 35.5 billion pesos in operating cash flow, up substantially from 19.6 billion pesos, and maintained a steady cash position at 60.5 billion pesos. Still, liquidity is not the only story. With investments and advances totaling 1.068 trillion pesos, the parent's exposure to long-cycle bets is vast. The timing mismatch between investment returns and debt service remains a central risk. In 2025, interest expense outpaced dividend income, and 2026 will test the company's ability to refinance, recycle capital, and extract returns from its strategic assets. San Miguel's parent remains committed to investing through the cycle, supporting subsidiaries, and maintaining a balance sheet built for scale. The challenge ahead is clear: efficiency in managing liabilities, disciplined capital recycling, and navigating financing costs are essential to sustaining growth. As 2026 unfolds, the question is not San Miguel's ability to fund its empire. It is how well the parent can turn investments into tangible returns while balancing debt and liquidity.